Hey everyone, it's Imran from Options Insight with your macro options spotlight for today. Now, before we jump in, if you like these videos, you like this type of content, please like and subscribe to the channel. That will really help us with the algorithm and get more people to see this type of options related content, and it will really help us grow. Okay, so another wild ride for stocks yesterday after an initial rally into FOMC got faded. As the Federal Reserve's projections showed a higher terminal rate of around 5.1% and also higher PCE inflation by the end of next year. So markets didn't like that too much. At the margin, it was considered hawkish, certainly for the equity market. And that 4,000 pin on the S&P that we've been talking about for Friday seems to have kind of contained the volatility and kind of acted as a bit of a gravitational force. Now, markets are a bit heavy overnight, so we have pushed a little bit through that down towards that 39.50 area, which also does have a fair amount of open interest. And that's on the back of China retail sales and industrial production missing estimates and taking broad indices lower. So Europe down there as well. Metals have been hit as well overnight. So gold not managing to get convincingly above that 1810 resistance that we've been talking about, and it's got faded back down to 1780. Obviously copper down as well, silver down pretty hard, whilst crude on the other hand, again, like I said, there seems to be a bit of negative correlation between the metals and the energy complex right now. Certainly oil, nat gas is its own beast, but oil managing to post another 2% up day yesterday. If we look at volatility, we do see vols getting hit another leg down as we'd been anticipating post-event. Obviously, US really where the juice has been in terms of implied vol. So that vol getting hit, deflating by about a vol and a half. European vols coming from a much lower base. They were actually finishing slightly firmer. And then Asian vols also getting hit pretty hard with Nikkei down 2 vols, which is quite a big move given that it's coming from around 15 vols now. Outside of that, we did see commodities vols lower in general as well. And that's just kind of in line with broader cross-asset volatility. Looking at carry, we see green all over the place in equities. Again, European indices seem to give you the best carry. This number on FTSE at 62% is pretty impressive, but that's because it's realizing 6.5 vol. I mean, I don't think it's going to stay quite that low. That typically is an anomaly when it gets close to 5 vol or less. So I wouldn't necessarily expect it to have quite so much, but having around 30 to 40% carry seems a bit more realistic. And that's what you're getting in European indices. We do think the market may hang in here into Friday, so not get too far away from this 39.50, 4,000 area. But then we may see more selling next week as markets are free to move again, because Powell does seem to have extinguished any hopes of an early pivot next year. And so the markets might find that they need to drift lower once some of this OPEX related flow kind of goes away. If we look at skew drifting lower in stocks as markets price out some more risk premium across the curve. Commodity skew is pretty mixed though, up and down. We do see oil puts better bid, and we see if we look at all the metals, copper, silver, and gold, all of them see negative 1-month risk reversals, which means calls are trading at a premium in the metals relative to puts. Okay, moving on. So we talked about the FOMC, and so it was a hawkish message from Powell in general. Markets' expectations obviously were for a 50 bip hike that was delivered, but it was really what the economic projections were saying: lower growth, higher inflation than was expected, higher terminal rates of 5.1%, and Powell saying he does not see rate hikes next year, and he needs to see substantially more evidence of inflation falling back to target, and that target is 2%. It is not being revised higher, and they're not going to discuss revising it higher, as some people were kind of maybe speculating. Now, this message was the main reason the market sold off, although rates, markets didn't do a whole lot, and that's because he did say rates were close to sufficiently restrictive, and that prevented those rate markets from doing much on the day. Now, speaking of the rates market, if we look at the implied Fed funds rate for the end of next year, it is a good 100 basis points less than what they're projecting. So they're projecting that Fed funds is going to be at 5.1%. The market's predicting it's going to be at around 4% by the end of the year, which means that the market does not believe that the Fed will be able to hold rates at 5% for the whole of next year. And they expect that a recession is going to force them to start cutting rates in the second half of the year. Now, one of the reasons for this disbelief is because the Fed has got a pretty bad track record at estimating the severity of a recession and how much it's going to impact employment and things like that. So the market really thinks the leading indicators of the jobs market are showing that the recession is going to be quick, it's going to be fast, and they're just not going to be in a position to be able to hold rates where they want to, basically. So they will see inflation collapse faster than maybe the Fed is anticipating. You'll see unemployment go up more than the Fed is anticipating, and therefore the idea of holding rates up there for that long just isn't going to happen. That's what the market thinks. Okay, moving on to what I'm seeing elsewhere. So we mentioned that in terms of equity sectors, we think ARK, there's some carry to be harvested there. It's one of the better ones. And on top of that, not just it's a higher level of implied vol. So if you look here, this is our cross asset vol matrix zoomed in, and ARK does stick out like a sore thumb with vol in the kind of 55 to 60 area, which is way above all the other equity sectors and above most other assets. The only assets with a vol higher than that are VIX, which is obviously a different animal, and Nat Gas, which is clearly a different animal. So ARK is a pretty high vol. Looking at the chart on ARK, you can see that any kind of rallies have been smacked back down pretty fast. So we do think this is trading quite heavy, and we do think the path is probably lower, but we don't think it's going to crash. So we do think, the sharp, stingy squeezes, because it is a shorted sector, we think they've gone now with CPI and FOMC out the way. So we don't think that's a huge risk. Also, Tesla, which is the third largest holding in ARK, is breaking down in terms of the chart and doesn't look very good either. So we do think the path is lower for this. The way we would kind of play it is, because the term structure is quite flat and the skew is quite elevated, as we look at put calendar structures. So that would be my favored way. Because if you look at the dashboard, you can see here the dashboard screening buy call spreads, because obviously spot is beaten up. But we're not really taking the other. We don't think that the spot weakness is a fade. We actually think the spot probably drifts at the margin because of the hawkish message that we're getting from Powell. We kind of don't think the pivot's coming, or the pivot speculation is even coming in the next sort of few weeks. So therefore we think it probably drifts lower. We've got a positive carry in the 90th percentile. We've got a term structure that's quite flat, which I think is likely to go like this and go into contango. And so when we've got an absolute level of vol that has retraced back towards the low end of the range, it's not necessarily a no-brainer to go and smash out the outright vol. Okay. Now, even though I do think vol probably does go lower, to be a bit more safe and a bit more conservative when vol's near the lower end of the range, but you still want to earn carry and harvest that theta, you're better off using calendars. And if you happen to have a directional view as well, then that calendar can work well for you. So my directional view is at the margin bearish. I think the curve goes into contango over the next few weeks into year end. I think the January bucket will get crushed. And if realized stays 40 or lower, I could definitely see that front end getting hit by about 10 vols and earning some good theta. Whereas I think the March part of the curve is going to hold up much better, because March is not until after the next FOMC. And in general, it's just a bit further out the curve. So that's the way the curve tends to behave, right? They tend to not smash that medium term part of the curve, and they smash the stuff that earns them carry, which will be January. So that's the trade I'm looking at. If we have a look here, we're starting to see the likes of FX vol, rates vol starting to collapse post FOMC. We've got rate guidance now and rate forecasts suggesting that, yes, we've had one of the steepest hiking cycles ever. But now the rates volatility is going to subside and it's going to grind its way higher. So if there's an anticipation that rates don't move as much next year, then FX probably doesn't move as much either. You may see this macro volatility heading back down to more normal levels, and you may see more downside in macro vol. So that's the big question. I don't know whether you agree with it or not. I'm starting to get into the camp. Yeah, the macro vol may well be dissipating for a while until we see the depths of the recession. And if the recession surprises people to the downside, and then you need to see rate volatility, but in the other way. So I don't think you're going to see rate volatility on the upside anymore, right? But if you do get a really deep recession that shocks people and the labor market really turns around, then you may see rates getting cut fast. And so rates volatility will come to the downside in rates and to the upside in bonds. And that kind of makes sense with what's been happening in bond skew, where bond skew has flipped away from puts and become more neutral. But I wouldn't be surprised as the year goes on for those calls on bonds to get an even bigger bid, because that's probably really where the explosivity of vol comes from on the other side. All right, that's it for today. Thanks a lot for listening, guys, and I'll catch you tomorrow.